Hi, I'm Siu Ling Hui, principal and founder of Cashflow Kung Fu. In this video, you'll learn what depreciation is and how it affects your business's finances, particularly profit and cash flow. Depreciation applies to fixed assets on your balance sheet. This group of assets is also called property, plant, and equipment, or PP&E for short. They are items that you buy to use in your business to help generate income for more than 12 months. Examples of fixed assets include land and buildings, plant and equipment, furniture, fixtures and fittings, computers, motor vehicles, trucks, and so on. The word fixed doesn't mean that they're not physically movable. It means they are part of your long-term business assets. That's why they fall in the non-current assets part of your balance sheet. Whether an item is a fixed asset or not depends on what it's used for in the business. For example, a car dealership buys and sells cars to generate income. These cars are bought by the business for the purpose of selling them as quickly as possible at a profit, so they are part of the business's stock or inventory. The dealership would also have its own cars for use by the business. These cars would be part of the business's fixed assets. It's the business purpose of the item that determines whether it's part of inventory or fixed assets. All fixed assets have finite useful lives. Land is the exception. Depreciation is an accounting concept which spreads the cost of a fixed asset over the term of that asset's useful life. The length of the useful life depends on the asset. For a computer, it might be 3 years, a bottling line, 8 years, a building, maybe 20 years. The reason for spreading the fixed assets cost is to match expense with income. A car or a computer or a building will be used in the business to generate income for more than 1 year. In other words, the cost is an expense that's related to future income in your business, so it shouldn't just be expensed in the month that you buy it. Imagine what it would do to your business profit if you charge the entire cost of a factory as an expense in 1 month. There are various ways for spreading the cost over the useful life. You could use the straight line method, the declining balance method, or the units of production approach. These are just 3 examples out of a range of possible bases of depreciation. Each method spreads the depreciation expense out in a different pattern over the years of useful life. Tax and accounting rules set out what the useful life of an asset is and the appropriate basis of calculating depreciation. Your accountant will know what applies to your business's fixed assets. Let's use a car as an example to see the effect of depreciation on your financials. I'm going to use a simple balance sheet so that we can focus only on fixed assets, that's the car, and depreciation. Let's say the business already has $4,000 in cash, and that cash came in by way of capital you put in. Your business buys the car for use in the business on the first day of January. The car costs $4,000. The car will show up in your balance sheet under fixed assets. In your cash flow statement, the cash flows for that first day of January will show the purchase of the car as capital expenditure under investment activities. Now, a car can't just magically appear on your balance sheet. The next question is, how did the business pay for it? Well, you could use that cash on hand, but that would mean you run your cash balances down to 0. Alternatively, you could do it by way of a financing facility from the bank. That means you'd have cash inflow from the bank loan and bank borrowings as a liability on balance sheet. Net cash flow as a result of the purchase of the car would then be 0. Or maybe you as a shareholder could make a loan of $4,000 to the business to buy the car. In this case, your cash flow statement would show cash inflow from a loan from shareholders, and you'd see that loan as a liability on the balance sheet. For the purposes of this exercise, let's assume that you as a shareholder lend the money to the business. This way, we don't run the business cash balances down to 0, and we also don't incur bank debt. Let's say the car has a useful life of 4 years for accounting and tax purposes. It's expected to have no value left at the end of 4 years. So that means it will depreciate or reduce in value by $1,000 a year, assuming we use what is known as straight line depreciation. This basis of depreciation simply means that the cost of the asset is depreciated in equal amounts over its useful life. So in this instance, the value of the car in your accounts will be reduced by $1,000 a year, and by the end of year 4, it's worth 0 in your accounts. Your business still has the car at the end of year 4, even though it has 0 value on the books. So how does an investment in a fixed asset like a car and its associated depreciation affect your financials? Here's a profit and loss with some simple sales and expense numbers. I'm holding these numbers constant across the period so that we can focus on depreciation. We're also going to ignore income tax for the purposes of this exercise. Depreciation expense is a way of allocating the cost of the car over its useful life. So in this example, we have annual depreciation expense of $1,000 in your profit and loss for 4 years. Over these 4 years, your business has to be able to produce enough income through using the car that will more than cover its costs. In other words, it has to generate a return on investment, or ROI. If you're still using the car in year 5, there's no depreciation expense because the car is already fully depreciated. You've fully expensed its original cost. So does that mean it's a zero cost to your business to keep using the car? It depends on the condition of the car. Is it at the point where repairs and maintenance are starting to escalate? Let's assume that repairs and maintenance costs stay the same as in previous years. Does the fact that you now have $0 depreciation expense in year 5 mean that your business is suddenly more profitable? It depends on what measure of profit you're looking at. There would be no difference if you're looking at a profit measure called EBITDA. That's earnings before interest, tax, depreciation, and amortization. We'll cover EBITDA and other different profit measures and their uses in other videos. For now, let's stay with the effect of depreciation in your financial statements. Let's look at what happens with your financial position. That's your balance sheet. Each year or month, if you're talking about monthly accounts, the depreciation expense charged in the profit and loss is accumulated in a line called accumulated depreciation on your balance sheet. This is a negative number that goes against each fixed asset. In this case, we've only got one fixed asset, and that's the car. So by the end of year 1, the $1,000 depreciation expense shows up as accumulated depreciation of $1,000 in your balance sheet. It reduces the value of the car in your accounts to $3,000. In year 2, the $1,000 depreciation expense for that year is added on to the accumulated depreciation of the car. So that takes the accumulated depreciation to $2,000 at the end of year 2. The net book value of the car at the end of year 2 goes down to $2,000. This process keeps going until the car is fully depreciated. That's when the accumulated depreciation is equal to the cost of the car. And that happens by the end of year 4. By then, the net book value of the car is $0. In year 5, there's no depreciation expense because it's already fully depreciated. The accumulated depreciation is at its maximum of $4,000. The net value of the car cannot get less than 0. The fact that you are still using the car, that it's still useful for the business, is irrelevant. In your accounts, the car has no value. But that doesn't mean that it disappears from your accounts. It won't disappear until you sell it. Before we deal with what happens when you sell the car, let's look at what happens with cash flow. Depreciation is not a cash expense. That's why it's added back to net profit in the cash flow statement. We are assuming that all other income and expense items are on a cash basis for the purposes of this exercise, so there are no working capital items. You can see that the cash flow from operating activities is still $5,000 in year 5 when there's no depreciation. Just because depreciation isn't a cash expense doesn't mean that it isn't a real cost to your business. The cash impact happened on the day that you paid for the car. Depreciation simply spreads the total cost of the car or other fixed asset over the period of its useful life. Your business has to be able to produce more cash than the cost of the car over the 4 years to justify the investment in the car. The term of a financing facility for fixed assets like cars, plant and equipment, and so on is usually matched to the useful life of the asset. If you finance the purchase of the car with debt, you've got to make sure that there's enough cash flow to pay the interest and the principal repayments associated with that debt over those 4 years. Now let's look at what happens when you sell a depreciable fixed asset. The key point to understand here is the difference between profit or loss versus cash flow with the sale transaction. We'll look at 3 scenarios: break even, profit, and then a loss situation. The net book value of the asset at the time of sale is the base used to determine whether you've made a profit or loss on the sale. Let's start with the break-even scenario. Let's say the car is sold on the 31st of December in year 3. You've got a whole year's depreciation expense in the profit and loss. At the end of year 3, the car has a net book value of $1,000. We sell it for $1,000. So that means there's no profit but no loss either. It's a break even. Selling fixed assets is not part of day-to-day operating activities. It's a transaction that only happens occasionally. In the profit and loss statement, items like these are usually grouped under other income or abnormal items and are shown below the operating profit line. Here's what the balance sheet would look like just before the car is sold. The car has a net book value of $1,000. When the sale happens, a whole bunch of accounting entries is passed. These entries result in every balance sheet line relating to the car becoming zero. The car is no longer part of the business assets. It's been turned into $1,000 of cash even if you didn't make a profit on it. The cash flow statement shows you the cash flows relating to the sale of the car. Profit, as we all know, is not cash, so any profit or loss on sale of the car has to be eliminated from the net profit figure in the cash flow statement. To do this adjustment, you deduct the profit on sale of fixed assets from the net profit, but if you have a loss, you add that loss back to the net profit number. The $1,000 that you got from the sale of the car is shown as a cash inflow under investment activities. So your net cash flow for year 3 is $6,000. $5,000 from operating activities and $1,000 from the sale of the car. Now let's look at what happens when you make a profit on the sale of a fixed asset. Net profit is higher than in the break-even scenario because you made a $1,000 profit on the sale of the car. You sold it for $2,000. That's $1,000 more than the net book value of the car at the end of year 3. But from the cash flow point of view, there's no difference in the cash flow from operations once you make the adjustments for depreciation and profit on sale of fixed assets. See how we've eliminated the profit on sale of the car by deducting it from the net profit figure? Your overall cash flow is higher because you received $2,000 cash from the sale. Let's go back to the balance sheet for a minute. That $1,000 net value of the car on the asset side of the balance sheet turned into $2,000 cash when the sale happened. Now, the balance sheet must always be balanced. What happens on the asset side must be matched by an equal number on the liabilities and equity side. That $1,000 surplus over the net value of the car is in the retained earnings line because it's part of the profits that your business has accumulated. Here's what your financials would show if you sold the car for $200. That's $800 less than the net book value of the car. So your profit and loss statement will show a loss of $800 on sale of fixed assets. Profit before tax is now lower at $3,200. In the cash flow statement, you add back the loss to the net profit figure to eliminate its effect from the operational cash flow. Notice how your net cash flow from operations is still $5,000, exactly the same as in the break-even and the profit scenarios. You made an accounting loss of $800 on the sale, but you still got $200 cash into the business. That cash inflow is picked up under investment activities in proceeds from sale of fixed assets. So your overall net cash flow for year 3 is $5,200, $5,000 from your operating activities and $200 from the sale of the car. To wrap up this training, let's cover off what cash outflows could be associated with the sale of fixed assets. If we had financed the car with a loan from the bank, the business doesn't get to keep the money from the sale. The proceeds of sale will have to go towards repaying that loan. If the amount owing to the bank is more than what we get from the car sale, we'll have to use our own cash to make up the balance that's still owing to the bank. Let's do a quick recap of the key points covered in this video. Fixed assets are items like land and buildings, plant and equipment, cars, and so on, which are used by a business to produce income over an extended period of time. Depreciation spreads the cost of the investment in a fixed asset over its useful life. This is a way of matching income with the cost of using that asset to generate that income. Depreciation is a non-cash expense. It doesn't affect operating cash flow. That's why it's added back to net profit in the cash flow statement. But that doesn't mean it's not a real cost. Your business has invested money in the fixed asset. You've got to generate enough earnings to recover the cost of this investment. If you finance the purchase of this fixed asset with debt, you've also got to generate enough money to cover the interest cost and principal repayments along the way. When you sell a fixed asset, The profit or loss is the difference between the sale price and the net book value, not the original cost. The profit or loss on sale is not cash. The proceeds from sale of the fixed asset is the cash inflow, and you see it under investment activities in your cash flow statement. I would really appreciate your feedback on this training. Please put any questions or comments below and I will respond. If you have a specific issue or question about your business finances, you can contact me directly through my contact page at incontextfinance.com. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.